It is common for people to overlook excellent tax-saving opportunities for two reasons. Either they simply do not know about them, or because tax laws constantly change, it's hard to stay on top of the latest deductions, credits, and exemptions. Saving money on taxes is one of the best financial decisions you can make. You can reduce your tax bill by taking lessons from millionaires who have spent a fortune working with tax professionals to find every loophole, deduction, and credit they can use to reduce what they owe the IRS. Hello and welcome back to the Finance Guardian channel. In this video, we will tell you how to avoid taxes like the rich, reduce your taxable income in 2023, new loopholes and tax credits. Hopefully, you'll be able to reduce your tax bill this year if you qualify for some of these tax breaks. So hit that subscribe button and the bell beside it, and let's get started. The first thing we'll be looking at is loopholes. But what exactly is a loophole? The term loophole refers to a technicality that allows people to escape the scope of a law without actually breaking it. Loopholes are often used in discussions of taxes and how to avoid them, as they provide opportunities to transfer income or assets from taxable situations into ones with lower taxes or none at all. This differs from lesser-known tax deductions or strategies designed specifically to save taxpayers money. What constitutes a tax loophole? It is easier to identify some tax loopholes than others. As I mentioned, by using loopholes, individuals and companies move money and assets to avoid paying taxes. For instance, if an American corporation moves offices and factories overseas, they may be doing so to save on taxes in their home country. In its most basic sense, a tax loophole is a provision in the tax code that enables taxpayers to reduce their tax liabilities. However, this definition should be widened to encompass shortcomings in the legislation which were not immediately apparent at the time of enactment. Usually, loopholes are unintended, meaning they weren't anticipated by the legislators or regulators who drafted the law. Furthermore, those taking advantage of the loophole, while allowed by law, nevertheless circumvent it due to its shortcomings. Several tax loopholes have closed over time, but here are three of the most common loopholes used by individuals and companies to avoid paying taxes. The carried interest loophole. This loophole allows hedge fund managers, venture capitalists, or partners in private equity firms to have their compensation taxed at a much lower rate than the regular income tax rate. While the income of an individual just as wealthy as a hedge fund manager would be taxed at the highest marginal tax rate, their income would be taxed at the long-term capital gains rate. Profits realized by hedge funds are classified as long-term capital gains, since they represent carried interest realized over the long term. Since hedge fund managers, venture capitalists, or partners in other private investment funds earn income from those long-term capital gains, they are subject to long-term capital gains taxation. Backdoor Roth IRAs. The current tax law prohibits taxpayers earning more than $140,000 per year from contributing to Roth IRAs, which allow tax savings to grow tax-free. However, since 2010, high-income earners have been able to circumvent this limit by converting a traditional IRA into a Roth IRA, a strategy known as a backdoor Roth IRA. Retirement savings could grow tax-free without any required minimum distributions, or RMD, once income taxes have been paid on the initial contributions and gains. Foreign-derived intangible income, FDII. Essentially, this income is the portion of intangible income received by a U.S. corporation that is generated through serving foreign markets. The White House says the Trump tax plan created an intellectual property loophole that allows corporations to take advantage of tax breaks by moving assets overseas. Several government legislations have also been drafted to intentionally help taxpayers save money. Contrary to tax loopholes, this kind of legislation is usually a part of a social safety net, or one that is intended to stimulate the economy. Take a look at these 5 tax credits that can save you money. The Saver's Tax Credit. When working-class Americans manage to save some money, they can claim the Saver's Tax Credit when they file their taxes. It is a tax break aimed at encouraging people to save money, especially since so many people lack or do not have an emergency fund or retirement savings at all. There is no refund available for the Saver's Tax Credit. It may reduce your tax bill to zero, but you won't receive the difference back if your credit exceeds what you owe the IRS. Earned Income Tax Credit. You can claim the Earned Income Tax Credit, or EITC, if you are employed but are not bringing in much income. Like all tax credits, the EITC directly reduces your tax bill by the amount of the credit. But unlike the Saver's Tax Credit, it is refundable. If the EITC amount exceeds the amount you owe the IRS, you will get the difference refunded. Working-class families have benefited greatly from the EITC because it has significantly reduced poverty. American Opportunity Tax Credit. Students who enroll in a higher education program after high school are eligible for this tax credit. The first $2,000 of your annual education expenses may be credited 100%, and the next $2,000 in expenses may be credited 25%. Although you may incur qualifying educational expenses exceeding $4,000 per year, you are only allowed to receive a maximum credit of $2,500 per year for each student for a maximum of 4 years. Receiving a partial refund of the credit is possible if it reduces your total tax liability to zero. In this instance, you may receive up to 40% of the credit amount, up to $1,000 back. Lifetime Learning Credit. Students enrolled in an eligible educational institution may qualify to receive a lifetime learning credit for tuition and related expenses paid to them. You can use this credit to pay for undergraduate, graduate, and professional degree courses, including courses to improve your job skills. It is worth $2,000 per tax return, and there is no limit to the number of years you may claim the credit. Child Tax Credit. This credit provides parents or guardians with a boost in income. To help filers cope with the effects of the pandemic, the American Rescue Plan increased the credit for 2021. Dependents aged 17 or younger are qualified on the last day of each tax year. The credit was worth up to $3,600 per dependent, but the amount you were eligible for depended on your income level. The credit reverted to 2019 levels in 2022. This means taxpayers who received $3,600 per dependent in 2021 will only get $2,000 per dependent in the 2022 tax year. Wealthier families no longer qualify for the credit. Moving on, some other strategies may help you keep more of your hard-earned money aside from taking all the tax credits and deductions you're eligible for and exploiting loopholes. Number 1. Don't miss the deadline. You could face hefty fines if you don't file your federal taxes or file for an extension by April 18, 2023. The deadlines for filing state taxes vary, so check with your revenue department for more information. Number 2. Contribute more to retirement accounts to reduce your taxable income. Since contributions to traditional IRAs, 401ks, and 403bs are typically funded with pre-tax dollars, adding to either will reduce taxable income and ultimately provide tax savings. Number 3. Contribute to 529 college savings. 2 potential tax savings are associated with 529s. While contributions are made with after-tax dollars, income earned while invested is tax-deferred, and money used for qualified educational expenses is tax-free. Contributions to those 529 funds may also be eligible for state income tax deductions or credits. Number 4. Make contributions to your health savings account, HSA. The HSA is an option for saving money for out-of-pocket medical expenses if you have a high deductible health plan or HDHP through your employer. 3 factors make these tax-advantaged. Payroll HSA deductions are pre-tax, growth is tax-free, and withdrawals for qualified medical expenses are tax-free. Number 5. Establish a flexible spending account or FSA. Pre-tax FSA savings through an employer can help you plan your budget and lower your taxable income if you know you'll have expenses like childcare, elder care, medical expenses, or prescriptions. It is important to check current IRS contribution guidelines for details, as the IRS allowed maximum savings are subject to change each year, and any unused savings will be forfeited. Generally, you cannot use an FSA if you use an HSA. Number 6. Adjust your paycheck withholdings. In 2022, the average tax refund was $3,039, a rise of more than 7% and about $250 per month. Conversely, withholding too little taxes from your paycheck might result in you owing money and possibly even being charged a penalty. Your Main Resources Department can inform you of the option of changing your payroll tax withholdings at any time. Number 7. Evaluate the performance of mutual funds and stocks. A tax professional can help you determine whether tax loss harvesting can be used to offset capital gains and reduce taxes if you own securities. The best thing you can do to manage your money effectively is to take control of your federal tax bill. After all, taxes can be a big expense. Paying more than necessary leaves you in a tight financial situation. The good news is that some of these tax-saving opportunities might work for you, and you may pay a little less in taxes next year. And that is all the time that we have today, folks. We hope you enjoyed this video, and if you did, please hit that like button. If you're new, subscribe to our channel to remain updated about our future videos. We'll see you next time.